Hello and welcome to the Global View on this Wednesday. Well, making news, China and Australia will restart annual meetings as trade resumes. Prime Minister Anthony Albanese meeting Chinese Premier Li Qiang as he continues efforts to rebuild a strained relationship with Beijing. The Prime Minister is on the first visit to China by an Australian leader in 7 years after a diplomatic dispute had put a halt to once annual meetings of leaders. President Xi Jinping saying on Monday that stable ties between China and Australia served each other's interests and both should expand cooperation. China has lifted trade blocks on most Australian exports imposed in 2020 after Australia's call for an international investigation into the origins of the COVID pandemic. And the latest data from Chinese customers shows that China's October imports from Australia grew 12% from a year earlier to just shy of $12 billion. Well, at a macro level, US Treasury yields have fallen as investors price in expectations that the Fed Reserve is near the end of its tightening cycle. The yield on the benchmark 10-year Treasury note was down more than 7 basis points at 4.58%, and the 2-year slipping to 4.93%. In what is described as a bull flattener, the slide in yields on the long end of the curve, much sharper than those at the short end. It's a scenario which normally precedes a cut in interest rates. Well, US rate futures are now pricing in a 52% chance of a rate cut by next May. However, Minneapolis Fed Bank President Neil Kashkari is saying the Fed may have to do more to bring inflation back down to its 2% target, given the recent run of resilient economic data, saying when activity continues to run this hot, that makes me question if policy is as tight as we assume it currently is. But Chicago Fed President Austin Goolsbee is saying the Fed's policy settings are working in slowing inflation, and if that continues, attention will turn to how long to keep rates at current levels, saying over the next couple of months we might equal the fastest drop in inflation in the last century. Well, the US dollar did gain as a sharp sell-off last week was seen as overdone in the short term, while the euro was dented by weak German data. And the Aussie dollar suffered its biggest one-day decline in a month after the Reserve Bank raised interest rates by 25 basis points yesterday, but offered guidance that the market perceived as indicating that further tightening is unlikely. The Aussie trading at 64.4 US cents. All right, so investors clearly have been focused on central bank movements and with a higher for longer narrative, of course, but the focus also on consumer spending and its resilience. To talk us through that, Tim Richardson joining us from Pengana Capital. Tim, good to see you.
Good to see you, Andrew. Thanks for having me back.
Yeah, I mean, you only have to look, I guess, as evidence as to what our own Reserve Bank did in response to consumer spending, where inflation is travelling at the moment. More globally, why is it that consumer spending has remained so resilient in the face of such a rapid rising interest rates?
That's interesting, Andrew. The first thing to highlight is consumer spending is slowing. It's just that it's slowing much more slowly and more gradually than most analysts had been expecting. If you look at the United States, for example, consumer confidence is still pretty strong there, and retail sales are holding up. Whereas if you look over to Europe, things are a bit more subdued over there, and in China, retail sales are certainly growing well below trends there now.
So is it your expectation then that spending will continue to slow, bearing in mind also that many central banks appear to be at the end of their tightening cycle?
Well, that's right. It's likely that trend is going to continue. Consumer spending is very tightly linked to income security, which in turn depends on the strength of the labour market. And what we've seen certainly in the US is that's remained very strong. The numbers have eased off a little bit, but it's still hard finding good workers. What that means is that it's given people the confidence to shift to jobs that pay a bit more, or even in the case of the car workers to go on strike in order for people's incomes to keep pace with the rising levels of inflation. The States has got a very high marginal propensity to consume. So that's why we've seen these strong consumption numbers. Even in Europe, where membership of trade unions is still pretty common, that's given workers a bit of clout in negotiating stronger incomes. Whereas if you look at China, where they've got 20% youth unemployment and a cultural tendency towards conformity, you see much more of a challenge for incomes over there. We're very much dependent on the strength of the labour market, but as you say, as interest rates keep rising, it is going to feed through to that over time.
Okay, so is it your assumption then that once we see the unemployment rate start to rise, you'll see consumer spending declining?
It is already declining, and you like to see there is a chance of a bit of acceleration. But I think we've got to be a little bit cautious about treating consumer spending as one single ubiquitous lump. Different sectors, different businesses are having very, very different experiences. For example, at the very top end of the consumer spending scale, the luxury houses, the very top end of the luxury houses, are actually holding up very well. I'm thinking of things like Hermes and Ferrari, where they have pricing power to pass through these costs through to the customers, and even increase margins through greater personalisation. Whereas other such brands, such as LVMH, came up with some quarterly data recently. They're perhaps facing a little bit more of a squeeze. So those businesses are seeing a bit of a difference.
What's your take out from US earnings, particularly, I guess, with the discretionary spending and those discretionary retailers?
Yeah. Big dispersion. The top end's doing pretty well. Those businesses that are delivering quality products but at discount prices, appear to be doing okay. Things like ELF Beauty, which uses social media to build market share with millennials and Gen Zs at attractive price points. They're taking market share off the more established players such as Estee Lauder, for example, and also discount retail stores, Costco, for example. That's by delivering a reasonable level of quality but at attractive value pricing levels, they're able to take market share as well.
So Tim, through an investor lens then, where should you be looking if taking into account the trends you're seeing globally in consumer spending at the moment?
Yeah, those parts of the consumer spending spectrum that are more resilient to the cycle that we're experiencing at the moment. The top end, quality of the discount price. The things to look for. Whereas things like clothing, athleisure, jewellery, household goods, those that are perhaps more discretionary items for the mid-market, they're perhaps going to come under some sort of pressure.
Regionally, are there perhaps areas that look stronger than others? And I guess we'd look to what's going on in China at the moment, for instance. You've mentioned perhaps Europe. Are you seeing a disparity there?
Yeah, very, very, very much so. As I said, the United States looks good. Some of the emerging markets, and I'm thinking in particular of Mexico, which is benefiting from the friendshoring as manufacturing production moves closer to the North American markets. Mexico's got improving corporate governance. That creates more jobs, more incomes, more consumer spendings. There's businesses such as FEMSA that's got a network of convenience stores across the country. They're seeing a nice uplift in the revenue levels. So those sorts of idiosyncratic situations look attractive. You mentioned China. That economy remains under pressure, and the consumer is pretty cautious over there, and we expect that to continue.
What are you seeing, particularly with the latest data out of China? We had those import-export numbers yesterday, higher imports, lower exports. We've had ongoing weakness with those PMIs, particularly in manufacturing. I mean, what's your view of the Chinese economy at the moment?
Its traditional role as an exporter is certainly challenged as the global economy slows down, particularly its propensity to consume goods as opposed to services. There's a shift in the West from goods to services that doesn't particularly favour the Chinese economy. The Chinese government, with its perennial focus on social stability, is taking measures to stimulate its economy, and that will lend a measure of support, certainly in the near term, towards economic activity. But it's got the long-term structural problems of the demographics, the extremely high level of property-related debt, and the focus on the state-owned entities.
Tim, how far across the investment horizon are you looking at the moment? Particularly, I was referencing this earlier with the market pricing in the States a rate cut by May. It's up to about 55% now, that bet. Are you taking that on board?
We certainly take it on board. We don't presume to have a competitive advantage in picking short-term interest rates movements. A long-term global investor is probably well as advised to establish a portfolio of shares that invest in businesses that will outperform in any reasonably likely economic scenario. But we're very mindful that there's a high chance that interest rates are going to stay higher for longer.
But are you perhaps skewing your portfolio perhaps more internationally at the moment, I guess, particularly compared with the Australian market, with assumptions that we're about 6 months behind what we're seeing in the States at the moment?
That's true. The Australia's been slower in the interest rate rising cycle, so it's therefore reasonable to assume that rates will start to move downwards earlier in markets such as the States, which were first off the blocks. But whether that is a symmetrical fall in interest rates is much more doubtful.
Tim, great to get your view from Pengana Capital. Thanks for joining us.
Thanks, Andrew.
All right, that is the global view. Just a check of where we're likely to open. We're expecting it to be flat, as you can see, just marginally higher, as according to SPI Futures. Stay with us. The open is just moments away.